Hello friends, welcome to the first session of the Term 1 examination. I am CA Renu Srikanth Tantry. Today we will cover two topics: partnership fundamentals, goodwill, nature and valuation. So let's start with the partnership fundamental questions. First question for discussion is: A, B and C are partners sharing profits equally, which means 1/3, because there are three partners. A drew regularly 4,000 in the beginning of every month for 6 months. So 4,000 was withdrawn at the beginning of every month for 6 months ended 30th September. Calculate interest on drawings at the rate of 5% per annum. Now in respect of interest on drawings, this is a regular drawing, and in case of regular drawing, the method that we use is the average period. So here, how do we calculate interest on drawings? The formula we will be using is interest on drawings is the amount of drawing, the total amount drawn during that period into rate divided by 100 into average period by 12. So here, the average period, how do we calculate? We take the average of the number of months for which the first withdrawal was outstanding. To that we add the number of months outstanding on the last withdrawal and then divided by 2 to get the average period. So to start with, we will first calculate the total amount of drawings here. It is said that A drew regularly 4,000 in beginning of every month for 6 months. So this is very important. Therefore, the amount of drawings in this case is rupees 4,000 withdrawn for 6 months. So it is rupees 24,000. Further, next rate of drawing available 5% per annum. Now we go for the computation of average period. Now we know that here the withdrawal has taken place only for 6 months. It's not for entire 12 months of the year. So when we calculate the average period, the first withdrawal which was made would be outstanding, being at the beginning of the month it has been withdrawn. It is outstanding for totally 6 months. And then the number of months for the outstanding for the last withdrawal. The last withdrawal will be made in the 6th month, beginning of the 6th. So it is outstanding for that one particular month. So 6 plus 1 divided by 2, that is 7 by 2 or 3.5 months is the average. Now with this, we just have to compute the interest on drawings using the formula, which would be the total amount of drawing being 24,000 into the rate of drawing being 5 by 100 into average period 3.5 divided by 12. So when you calculate this, you will get 350 rupees. So that is the interest on drawing. Therefore, answer here is C, 350. Now let us discuss the important point of this question. First thing is that the drawings was for 6 months. Therefore, when you are calculating average period, you have to be careful and calculate accordingly. Secondly, when you are calculating the amount of drawings, remember that 4,000 was withdrawn only for 6 months period. Don't multiply it by 12 blind. Thirdly, calculate correctly and set, because if you take 3.5 divided by 6, then it would be a major mistake, because it's for 6 months, because the rate of interest has been given as per annum. So always the denominator here would be 12. The average period only changes according to the calculation here for 6 months period. So I hope that is clear. This was a concept related to interest on drawings. And further, one more important point: check whether the drawings is out of profit or drawings is out of capital. In case the drawings is out of capital, please do not compute interest on drawings. Interest on drawings cannot be charged on the drawings out of capital. It would affect the calculation of interest on capital. Only on the drawings out of profit that interest on drawings can be charged by. So now moving on, Now let us go to the next question. We learn one more concept here. Now here, Ramesh and Suresh are partners sharing profits and losses in the ratio 3:2. Before profit distribution, Ramesh was entitled to 5% commission on net profit after charging such commission. So he's entitled to 5% commission and that is on the net profit, but that net profit is after charging such commission. So while reading, this has to be kept. Further, the firm's net profit before charging commission was 84. So this is the net profit of the firm before you have deducted the commission which was due to Ramesh. What have they asked? Suresh's share of profit will be. We are supposed to find out what is Suresh's share of. So first important thing here is the computation of the commission which has to be deducted from this net profit. And then whatever is left would be our divisible profit. In that we have to find out Suresh's share, which is 2/5. So let's start. Now, in computation of the commission, the important point to be remembered is that the net profit they have given, the percentage of commission is on after charging such commission. But they have given the net profit before charging commission. So here, remember the formula that you will be using for computation of commission would be on the net profit before charging commission, that is on 84,000, you will multiply the rate of commission by 100 plus rate of commission. Okay, so if we calculate the commission here, the commission to be given to Ramesh would be 84,000 into 5 divided by 105. When it is after charging such commission, you take it as 5 by 105. That would give you an amount of rupees 4,000. So that is the commission. Now we have got the net profit which was before charging the commission, which was rupees 84,000. From that, let us deduct the commission to Ramesh, which you've just calculated here, 4,000 rupees. So 80,000 is the amount of divisible profit. Now, this is going to be divided between the two partners in their profit sharing ratio. We are just supposed to calculate Suresh's share. So Suresh's share of profit is 3:2 means 2/5. Therefore, Suresh's share of profit is going to be on 80,000 2/5. So calculate that. So it is going to be 32,000 rupees. So the answer here is A. 32,000 is Suresh's share of profit. So hope this concept of commission, you will not apply direct 5% because it is to be charged on a profit after charging. If the term was before charging, then the formula would be rate by 100. You have taken 5/100, but because it is after charging commission, you should take 5/105. That is rate of commission by 100 plus rate of commission. So hope this concept is also clear to you. Now moving on is the next question. X, Y, Z are partners sharing profits and losses in the ratio 3:2:1. X has given a guarantee to Z. So guarantee has been given by X to Z for minimum share of profit for the year after meeting Z's deficiency of 40,000. So deficiency of Z is rupees 40,000. X gets his share of final net profit of 1,10,000. What is the guaranteed amount of Z? So I have a suggestion here that you can pause the video as soon as I finish up with the question and you can try solving. And then you can again start the video to see whether you have solved it correctly in case you are already familiar with the topic. So let's continue now. Now here we are supposed to find out the guaranteed amount of Z. Now what is deficiency? The formula for deficiency calculation is from the guaranteed profit which has been given, if you deduct off the actual share of profit to that guaranteed partner, you will get the deficiency. And here we have the deficiency amount of 40,000 available. But we do not have the guaranteed profit, neither the actual share of profit. So further, we will see who is the guaranteeing partner, this X. So X, the guaranteeing partner, gives from his share of profit the amount of deficiency of the guaranteed partner. So here X is giving that 40,000 to Z, which is a deficiency of Z. And here from the information we have been given that X gets his share of final net profit of 1 lakh 10, which means after he has given away 40,000, he has received 1 lakh 10. Therefore, the final net profit that X has got is rupees 1 lakh 10,000, and he has given away the deficiency, which is 40,000. So the amount of the actual share of profit before the deficiency of X was 1 lakh 50, and this he was getting as 3/6 share. So X was getting for his 3/6 share rupees 1 lakh 50,000 as net profit. So let us see what Z was getting. So Z was entitled to 1/6. So for 1/6 share, how much? I use a cross multiplication method. I cross multiply this. So I will get 1,50,000 into 1/6 into, this would be the reciprocal like this. So I get that as 50,000 rupees. Okay, this is how we calculate. So this was the actual share of Z, which is rupees 50,000. Now we know the deficiency. So we write the deficiency which has been given by X. So the deficiency which is made good by X is 40,000. So if we add the deficiency to the actual share of Z, we get 90,000. This is the guaranteed amount of Z. So this is how by reverse calculation we arrive at the guaranteed amount of Z. Therefore, D is the answer here, 90,000. So hope this guaranteed profit topic is clear. Here we learned about what is deficiency. The difference between the guaranteed profit and the actual share of profit is the deficiency. Who gives the guarantee? The guaranteeing partner gives to the guaranteed partner. From his share of profit, he will give away what is the deficiency to the guaranteed partner. And this is how we find out the amount of guaranteed profit of Z. So hope this is clear. Now let us move on to the next question. Now here I am just going to be discussing with you case-based question. This is also a type of question which you will be coming across, where an entire case would be given and 3 to 4 questions might be based on that particular case. So let us now read the case. Asif and Ravi are partners sharing profits and losses in the ratio of 3:2. Their fixed capitals were, as on 1st April 2020, were 6 lakh and 4 lakh respectively. The partnership deed provided for the following. 1. Interest on capital to be allowed at 5% per annum. Interest on drawings to be charged at 4% per annum. Ravi, the second partner, is entitled to commission of 5% net profit of the firm before charging such commission. Asif is entitled to a rent of 3,000 per month for use of his premises by the firm. Both the partners withdrew rupees 5,000 at the beginning of every month for the entire year. Net profit for the year before providing for the above was 4 lakh. So this is the case. Now we are going to be answering questions related to this case. So pause the video and try attempting the questions and then come back and recheck. So first question. The amount of interest on Ravi's capital shown in profit and loss appropriation account is. So they want us to find out what interest Ravi is entitled to on his capital. So for this purpose, the concept that you need to know is that interest on capital is to be allowed only when it is provided in the partnership deed. So here the partnership deed is provided for interest on capital at the rate of 5%. So Ravi is entitled to 5% per annum interest on capital. The second concept that you need to know is that interest on capital is calculated on the opening capital. Therefore, you have to calculate the opening capital if it is not directly available. But in this question, it is directly available. They have followed fixed capital system and they have on 1st April 2020 capital is 6 lakh and 4 lakh. So Ravi's capital is 4 lakh. Formula for calculation of interest on capital. IOC here represents interest on capital. It is opening capital into rate by 100. So the amount of interest on capital of Ravi, which you have to calculate, would be his opening capital is 4 lakh into the rate of interest on capital provided in the deed is 5%. So that comes to rupees 20,000. So this is the correct option. B is the answer for this question. So I hope that is clear. Moving further, I go to the next question, which is how will the rent paid to Asif be treated? Now, Asif, let's go back to the question and see. They have said in this fourth, Asif is entitled to rent of 3,000 per month for use of his premises by the firm. So, is entitled to 3,000 per month. Now, important concept here. The concept here is that there are certain items of payments made to the partner which are treated as charge against profit. What are those? There are only two items. So, items related to partners treated as charge against profit are rent to the partner. When partner has let out some premises to the firm, he is entitled to get rent on that particular premises let out. Second, when the partner has given some loan to the firm, he is entitled to get interest on that particular loan that he has provided. And both these items are not appropriations, but they are charge against profit. Now, what do you mean by charge against profit? Charge against profit means it goes into the profit and loss account. On the debit side, you will be putting the rent to the partner and interest on partner's loan, if any, into the profit and loss account, which will go to reduce the net profit. Appropriations of profit means it goes into the profit and loss appropriation. Here, the rent is being paid to Asif, a partner, and he has let out his property. So, he is entitled to rent. Therefore, we know that it's a charge against profit and it is to go to the profit and loss account. And it would go to reduce the profit. Now, let us look at the option. First option is it will be in the debit side of profit and loss appropriation account. It's false. It goes into profit and loss account. Second, it will be subtracted from net profit. Yes, because it is a charge against profit, it would go to reduce. So, B is the correct option. So, go further and see. It will be added to the capital account of Asif? No. And will be deducted from capital account of Ravi? No. I'm asking you to read all the four options because sometimes the C option also might be correct and in the D they might give both B and C. So always read all the four options before taking it. So here the rent which is paid to Asif is treated in this manner that it will be deducted from net. So hope that is clear. Moving on, we will go to the third question on this case. How much commission is to be given to Ravi? Now, commission to a partner in the previous MCQ, we saw that when it was on net profit, after charging commission, it was rate by 100. Now, here in this case, again, let us see. This is the case where Ravi is entitled to commission of 5% on net profit of the firm before charging such commission. So, here in the formula, when we take the net profit, we will be multiplying it by rate by 100. It is not after, it is before. It will be 5 by 100. Now, what would be the net profit? Now, you have to remember that there was one item of charge of profit, that is rent paid to Asif, a partner, for use of his premises. So, they have given the net profit for the year before providing for above, and therefore this rent has not been deducted from us. So, we are supposed to calculate the amount of rent and subtract it from this net profit, and on that we are supposed to calculate. So, first we take the net profit as is given to us, which is rupees 4 lakh, and we are supposed to deduct the rent to the partner Asif, which was 3,000 per month. So total of 36,000 has to be subtracted. So you are left with 3,64,000. Now use the formula for calculation of commission to Ravi, which is on 3,64,000 of profit at the rate of 5%. So when we calculate this, we get an amount of 18,200. Therefore, the correct answer would be B, 18,002. So here, important point you have to remember is that you cannot take entire 4 lakh and calculate 5% on it. You are supposed to subtract the rent, which is charge against profit, and on the balance amount 3,64,000 only comes into profit and loss appropriation account. On that only the partner Ravi is entitled to commission. And the second point is that the commission rate which was given was on net profit before charging commission. Therefore, it would be calculated as net profit before charging commission into rate by 100. So I hope that is clear. So this is how you will be getting questions in your examination. So with that, we come to the end of the first topic, that is partnership fundamentals. Now moving further, we will start the next topic for today, goodwill, nature and valuation. So here, let us take up the first question. Goodwill of a partnership firm is 10 lakh rupees, calculated on 2.5 years purchase of average profit of last 3 years. They have given the profit for 2021 is 7 lakh, 2020 is X, and 2019 is 3 lakh. What is the value of X? They have asked us to calculate this X. So for this, we first need to know what is the formula for calculation of goodwill. Here we have been given the amount of goodwill. They have given us the number of years purchase, and they have said it is that many years of purchase of average profit. So goodwill formula is average profit into number of years purchase. Therefore, here 10 lakh rupees, which is the goodwill, is equal to the average profits which is not directly available into 2.5 years. So we get average profits as 10 lakh divided by, when we bring it to the other side, it becomes division. So you get 4 lakh rupees. So this is the average profit. Now, what is the formula for calculation of average profit? You just take the total of all the profits of the 3 years and divide it by the number of years. Here it is 3 years, so you divide it by 3. Therefore, the average profits formula would be, here we have 7 lakh in 2021, we have X in 2020 and 3 lakh in 2019 divided by 3. But we know the average profit as per this calculation we got is 4 lakh. 4 lakh is equal to, I add this up, 10 lakh plus X divided by 3. Now this 3 going to the other side becomes multiplication. So you have 12 lakh is equal to 10 lakh plus X. So to find out X, take this 10 lakh to the other side. So it is 12 lakh minus 10. So it is 2 lakh. So the correct answer is C, 2 lakh. This is the profit of the year 2020. So this is how we go about calculating goodwill of a partnership firm when we have to go reverse calculate and find out the profit of 1 year. So here the two concepts we learned were the formula for calculation of average profit as well as formula for calculation of goodwill. Now moving further to the next question. Let us read this question. A firm earns rupees 1,10,000. The normal rate of return is 10%. Asset of the firm is 11 lakh and liability is 1 lakh. Value of goodwill by capitalization of average profit will be. So here we are supposed to calculate the goodwill of the firm, and the method we are supposed to use is capitalization of average profit. So first let us understand what is a step which we have to follow. If we follow the step, we will be able to arrive at the amount of goodwill very easily. So there are only 4 steps that you have to follow. First step is you calculate the average normal profit earned. Now in the case of this example, they have directly given the firm earns 1,10,000. They have not given the different years and the different number of years that you calculate the total and divide it by the number of years. You take this as the 1,10,000 as the average normal profit earned. So first step is you have the average normal profit as given here. We'll take 1,10,000. Clear? Moving on. Second step, we have to compute the capitalized value of the firm. The formula for calculating the capitalized value of the firm is you take the average profit divided by normal rate of return into 100. So what we're trying to do is, for earning this profit at this particular normal rate of return, what should be the capitalization of the firm that we are trying to estimate. So now here we have to find out capitalized value of the firm. So we have the average profit here 1,10,000. The normal rate of return given here is 10%. So divide by 10 into 100, you get it as 11 lakh. So we have ascertained that 11 lakh is a capitalized value of the firm. Now moving further, third step, we are supposed to compute the net asset. How do you compute? The formula is we take all the assets, but remember, in case individually they have been given, then you have to remember to exclude certain assets like the goodwill, non-trade investment and fictitious asset from it, and then subtract from that the outside liabilities. But in this question, it is very simple. They have just given assets of the firm were 11 lakh, liabilities 1 lakh. No further details. So we'll just take that it's all exclusive of all this, and we will calculate the net assets here. So net assets here would be rupees 11 lakh of assets minus 1 lakh of the liabilities. So that gives us net asset of 10 lakhs. So finally, the last step, that is would the calculation of the goodwill, which is nothing but the amount that you got in step 2. That is a capitalized value of the firm minus the amount of net asset that you got in step. That is 11 lakh that we have got in step 2 minus 10 lakh that we got in step 3, which leaves us with 1 lakh, which is the value of the goodwill of the firm based on the capitalization of average. So the answer is 1 lakh. So I hope it is clear. Just note down these 4 steps, and from the available information, follow the steps. Through the simple method, you'll be able to calculate without mistake the goodwill by capitalization of average profits. Now moving further, we go to the third question. Now here the question is, they have given the average profits of the firm is 1,50,000. So it is directly given. They've given total tangible assets of the firm 15 lakh and outside liabilities 5 lakh. Normal rate of return in similar business is 10%. Calculate goodwill by capitalization of super profit. So now in this question, I will be explaining you the steps that you have to follow to calculate goodwill using the capitalization of super profit. So for this, there are 5 steps. First step is you calculate the capital employed or the net asset. How to find out? We just saw in the previous question that we take the total tangible assets or total assets which exclude certain items like goodwill, non-trade investment and the fictitious asset, and from that we subtract the outside liabilities. But again here the details are not given. We just take the total tangible assets, from that we remove the outside liabilities. So the first step would be we calculate the capital employed or the net assets, which comes to total tangible assets of 15 lakh minus outside liability of 5 lakh. So you get 10 lakh as the net asset of capital employed. The next step is you will be calculating the normal profit on capital employed. So if this is the capital employed, what is the normal return which is expected in similar business? They have given it as 10%. So we calculate the normal profit. That is nothing but the capital employed that we have computed 10 lakh in the first step into 10 by 100. So we get that as rupees 1 lakh. So we got this is the normal profit any firm in this particular line of business will be able to get. Next step is we calculate the average profit. But for us that difficulty has been removed. They are directly given. So we have the average profits directly given in the question of rupees 1,50,000. Now the fourth step is calculation of super profit. The formula for super profit is average profit minus normal profit. What does this mean? It means that if the profit earned by the firm is more than what other firms using the same amount of capital will earn at the normal rate of return, then it means the firm is having super profit. So in this case, if you see, the super profit amount will work out to, the firm is earning on average rupees 1,50,000 as against the normal rate of return. The other firms would be earning the same capitalization in their business, only 1 lakh. So it is earning excess of 50,000 profit in comparison. So this is the super profit of the firm. Finally, we will calculate the goodwill of the firm. The formula for goodwill using super profit method, that is capitalization of super profit method, is you take the super profit multiplied by 100 divided by NR. That is a normal rate of return. So here we have just got now 50,000 as a super profit multiplied by 100 and divided by the normal rate of return, which is 10. So here we get this 5 lakh as the goodwill. So B option is the answer. 5 lakh is the goodwill arrived by computation capitalization of the super profit. So follow these 5 steps and calculate the goodwill using capitalization of super profit method. So hope that is clear. So I have tried to cover both the concepts, and here from this concept you can also, using super profit method, you can calculate. You follow till the 4th step, and the 5th step for goodwill, just if you are using just the super profit method, you just multiply the super profit with the number of years purchase. But because this is capitalized super profit, the goodwill was super profits into 100 by normal rate of return. So if it was goodwill by super profit method, stop in the step 4, take the super profit that you've calculated multiplied by the number of years purchase given to get the goodwill by super profits method. So I hope I've covered ample amount in goodwill. Now moving on. Now the next type of question that you are likely to face in the exam is assertion and reason, where you'll be given an assertion and a reason. You're supposed to identify which one is correct. So the question would be like this. In the following questions, a statement of assertion is followed by a statement of reason. Assertion is represented by A, Reason is represented by R. Mark the correct option as A if both assertion and reason are correct and the reason is the correct reason of A. So if reason is a correct explanation of A, then you will mark the option A. Second, B. Both A and R, that is assertion and reason, are correct, but reason is not the correct reason of A. The reason given is not a correct explanation of the assertion given. Then the assertion reason might be independently correct, but reason is not correct explanation, you mark option B. C is only if the reason is correct, if the assertion is wrong. And D, when both assertion and reason are wrong. So let us try doing this. You might be very familiar with this type of question. Now let us see the first question. First one, assertion is interest on drawings is recorded in the debit side of current account when fixed capital method is followed. So when fixed capital method is followed, you know that there are going to be two accounts open, capital account, current account, and through the capital account only the additions, permanent additions and withdrawals of capital will be recorded. All the items of appropriations, whether it is the interest on capital, commission, rent, or the salary to partner, or the interest on drawing which is credited, the profit and loss appropriation account, all goes through the current account. So here the assertion that interest on drawing is recorded in the debit side of current account is correct. It will go into the debit side of current account when fixed capital is followed. So assertion is correct. Therefore, it must be between A and B. Now let us look at the reason. The reason is the capital of the partner is fixed and all the transactions are recorded in current account. Yes, when the capital is fixed, all these transactions of appropriation will go through the current account. So here, both the assertion and the reason correct. And reason is a correct explanation of the assertion. Therefore, it is option A, which is the right answer. So hope now that is clear. We'll do one more question on assertion and reason. Now, assertion here is goodwill of the firm is affected by its favorable location. Yes, if the firm has a location which is very favorable, if it is like in a very good location, it will be able to get more customers. So its business will prosper. Yes, so the assertion is true here. Going to the reason. Reason, the goodwill of the firm is dependent on good labor relation. Reason by itself that goodwill of firm is dependent on good labor relation is also correct. That if you maintain good labor relation, they will work for the firm as if it is their own firm and with dedication, and therefore that would further improve the goodwill of the firm. But is the reason correct explanation of the assertion that goodwill of the firm is affected by its favorable location? I don't think so. It is not. Because favorable location is in itself one of the factor affecting goodwill and good labor relation is another factor affecting goodwill. Therefore, the reason given here is not correct explanation or correct reason for the assertion. And therefore, if you go by this, your assertion reason independently are correct, but reason is not correct reason of the assertion. And therefore, answer to this would be option B, where assertion is correct, reason is also independently correct, but reason is not a correct reason of the assertion. So this is how we'll be solving the assertion and reasoning question. So friends, I hope you have got clarity on the above topics and concepts. So if you found this video useful, then do like it and please leave your valuable comments in the comment section below. And do share it with your friends who are also attempting term 1 exam in this December month. So see you soon in the next session with 2 more topics on partnership. So stay tuned.